Hello everyone. Um, am I audible? Yeah. So today we are going to discuss the analytical review procedures that we can apply in our auditing premise. So just to give you a short introduction, I am Padmashri Krasto, practicing chartered accountant. I have 21 years experience, and I have been conducting audit of various listed and non-listed companies, and also I am into the audit quality initiatives in the firm. Today we are going to discuss something that is analytical procedures that we can use in the audit. To give you a background, when we do the audit, uh, when we plan the audit basically, and when we plan the strategy for the audit, we have always three types of testing that we can do. One is our TOC testing, which is test of controls. Second is the analytical procedures that we are focusing on today. And third one is our testing of details or other substantive procedures, as we call. Now, because of the IFC and because of the the framework that IFC has made it mandatory for all the companies to report on, TOC has got its own, pros and cons and its popularity. Now, coming to the test of details or the other substantive procedures, which involves vouching, verification, confirmation, and all that, those are seeming to be usually the practices that people follow often. There is nothing that is, people hold back when there is a smaller amount of transactions, when there are, it is quicker to do OSPs and it is quicker to get assurances, and people quite often go with OSPs in terms of how they want to look at the overall audit procedures. Analytical procedures is something that can give some insights, right? So these days, whenever even we want to do an audit of a larger company or even in a smaller company, so we say data is gold today, right? So data is everything and data is gold today. So when we have data as the mine or the data as the gold, there is so much that data can speak to us. So there are a lot of analysis that one can do with the data. So some of the basics I've tried to cover. Yes, when we speak about, I'll give some examples on how can be the digging of the data can be done. Data analytics in itself is such a vast topic that there are courses on data analytics. There are certified data analyst engineers. There are people who have taken up data analytics as their career, right? And the same underlying data is going to help us in doing the audit. For example, when someone is doing a forensic audit, he is using his data patterns and things like that. I'm today not getting into that detail, but however, trying to touch upon certain things that we can use in audit. And these data analytics will help us, or the analytical procedures will help us find some risks, also address some risks, and also try to help us in the concluding of the audit. Now, when do I do the data analytics? Data analytics is generally done throughout the audit. It's not restricted to at the beginning, at the end, and the execution. It can be done throughout the audit because data comes to us in different forms. And obviously, these days there is no one who has manual bookkeeping. Everything is electronic, so we are able to download dump. We are able to download so much of information from the systems, whether it be tally data, or it is as complicated as a SAP or the ERP or some specifically made up software, or a customized software, I would say. So there is so much that can be done in this space, but as of now, I think this is something that is underutilized to gain some comfort. So starting with that, we are going to look at few aspects of scope and objective of SA 520, use at different stages of audit, what is the requirement of SA 520, and then preliminary analytical review, the substantive analytical procedures, and the final analytical procedures. So these are different stages in the analytical procedure is called by different names at different stages of audit. For example, the PAR is at the planning stage, substantive analytical is in the execution stage, and final analytical is in the closure stage. So these are called by different names and they have different purposes and there are different ways of how you are doing it, right? And then also how to get assurance. So doing data analytics but then not getting assurance um, is not something that we want to do. So how to get assurance, how to ensure these things are falling into place. And obviously everything that we do has to be documented. No work done without no documentation. We always go by that funda. And how do we document everything in terms of the reviewability, the reliability, also the presentability. So few points on how to document this stuff. The scope and objective, obviously the scope, the use of analytical procedures during planning, substantive and final review is something this standard covers, SA 520 covers these things. The objective, to enhance audit effectiveness by identifying anomalies, trends and inconsistencies. We are going to more and more talk about all this stuff as to how we can identify the outliers, anomalies, trends, inconsistencies while doing all these kind of data analytics. Simple definition of data analytics is nothing but analytical procedures which are involving evaluation of the financial information by studying the relationships, the trends among the data, including the comparisons, ratios, as well as the expected values. So this is more theoretical, but then we can get into more of practicality. How I look at is that it is difficult to write analytical review procedure rather than to do it. So when you have something like a there are various tools available in the market. If you have something like Excel, or if you have something add-on that you have had, some other tools that you have purchased off the shelf, anything that you have, once you start doing it, you can play with the data and then you can come up with actually beautiful insights and also unearth some of the things that actually otherwise we cannot be able to, because only by doing an OSP, you're taking out a sample and then you're doing certain procedures on that. But if you're using analytical review, actually you are going to cover the entire gamut of data and then you can actually derive exceptions. You can look at the trends, you can ask for differences. So there's a lot of reasonability analysis that we all can do, right? Use at different stages of audit. Analytical review is throughout the audit, but it is called with different names. During the risk assessment procedures, it is generally called as preliminary analytical review. Substantive analytical procedures is during the execution area wise that we will do. Final analytical is generally at the stage of completion that we do. What are the requirements of SA 520? If you have to look at what are the requirements of 520. So everything that we do as an audit, we need to do in compliance with the standards of auditing. When we talk about the data, there are things that are very, very essential to be kept in mind. As we all know, when we talk about data, we need to check the source. We need to check something called as the information produced by the entity, which is like how authentic, how useful is that information that is produced by the entity. Then do a completeness check, whether this is appropriate, whether this is complete. So there will be certain, before we apply any analytics, these are the thumb rules that we have to look at, reliability, relevance, and the integrity of the data. These three things go without saying. Reliability of the data, where is it coming from, how is it coming from, who is retrieving it, is anyone actually tinkering any of the things, or is anyone actually doing any issue, creating any issue into the data, is there anything that is actually kind of hampered or tempered or things like that. So that is reliability of the data. Relevance of data, for example, if I'm doing sales analysis, then what is the relevance of data? Which is the year period I'm picking up? Which type of data I'm picking up? What is the source and all that? That is the second thing. Then the third thing, integrity, is also along with the reliability, in the sense that how integral is the data? Is there any changes? Is there any tinkering? Is there any tampering of the data that is done? So reliability, relevance, and integrity goes without saying of any data. When we retrieve and when we think of retrieving some data, there are few other things that we have to keep in mind. We have to look at the source of the data. Where is it coming from? Is it a inbuilt report? So you have to go and check the source of the data to say whether this system is actually retrieving the report in a proper format. Just to take a simple example, the data's aging, the trade receivables aging. So I need the data in the bucket of 30 days, 30 to 60 days, 60 to 90 days, more than 180 days, 360 days and above. For example, the system gives me a report. Maybe the total of all the columns will tally to trade receivable. How do I check the authenticity of this report? Is that I will have to use something called as an IPE calculator or a information produced by the entity. First, I will go and check how this source is authentic, not authentic. Is it coming from the system? Okay, everything coming from the system, good. But then is the system giving me correct report? So pick a few samples from that less than 30 days, check the invoices to see whether they are less than 30 days, pick up something from 60 to 90, pick up something from 90 to 180 and check whether the data itself is authentic. Third, if you are getting into an environment like SAP, ERP or things like that, then you have to go one step ahead and then also check whether it is actually the tables that have been prepared into the SAP or the ERP while doing the ITGC and the ITAC, IT application control, IT general control. So there are two things. If the entity has a lot of applications, then you will need to do an ITAC also. So ITGC plus ITAC. When you are doing that, you will have to check this authenticity of that also. So based on which the IPE or the information is produced by the entity and it is coming to you, right? So always when we take it, it is whether I'm taking the right thing. Because if I take in something wrong, then maybe my entire procedure will not have any value and it will fall apart. So that is first thing. That is essential. Now, what are the requirements of SA 520? SA 520 tells you that, okay, you can use analytical procedures. One, design procedures with very clear expectations. So what is it that you're going to derive? Just to take an example, if I'm doing a sales analysis, how all can I do sales analysis? I can do sales analysis by salesman wise, by geography wise, by margin wise, by product wise, by division wise, I don't know, SKU wise, individual unit wise, or whatever. So, what is it that I want to achieve? So, I can do any number of analysis, but what is it that is going to give me the desired output? So, we need to start up with a clear expectation. If I want to see what is the product margin, so maybe I will do a margin analysis and a product profitability analysis instead of a salesman wise analysis. If I want to see where are my products being sold more, so then I will do a little bit of more geographical analysis as compared to the product wise analysis. If I want to say in which area which product is being sold, then I will combine my geographical plus my product analysis. So there can be permutation, combination, slicing, dicing of data vertically as well as horizontally. What I mean by that, when we say vertically, it may be individual unit wise, division wise, or stuff like that. And then horizontally, what we mean is that, more in detail product wise or, particular salesman wise, unit wise, or the reporting type wise. So there can be anything, any combination of these things. But then when we start off with the data analytics, we need to be very clear of how do we do the design procedure, how do we design the procedures, and what are our expectations. So if my expectations also has to be appropriately defined. Use reliable data sources. Now, one of the things that is very important to note when we are talking about the analytical review is that the comparable data. So the step one of any analytical review, we will come to the steps. Step one of any analytical review is take a base data, then take draw a desired expectation, then actually take the comparable also, right? The more the data is external to the entity, the assurance that you derive is higher. So the reliability of data that you take from internal sources as well as external sources has to be higher. If you have more reliable data from outside or independent data plus more internal data, then the assurance that you can derive from that is higher. For example, I want to, we all know that as per guidance note on, the IFC, we can never have only TOC. It has to be only TOC, does not suffice as an audit procedure. We always have to do something more. And what is that something more? People generally jump to the OSP or the vouching verification and things like that. But it is more relevant in many cases to do uh, SAP or the substantive analytical procedure rather than OSP, right? So that is when I have to think about like what is it that I am supplementing with. So when I am supplementing with something, then what is the expectation? Then when I'm talking about the expectation, then I come to what is the reliable data source and how much assurance do I want? Do I want reasonable or more moderate or more assurance, or do I want limited assurance? I am going to make a combination of TOC plus OSP plus SAP. Then I need maybe moderate kind of assurance. But I can get reasonable assurance if I can do more in the data analytics. That means my internal as well as external data is independent data is also higher, and then I have more reliability on the data. We talked also about the reliable data sources and verification of ITGC as well as ITAC. Right, this needs to be checked at that time as well. Investigate significant deviations. We will come to that more in detail because this is the next requirement of the standard. So once we do the comparison, once we do the analysis, we can't leave it just like that. We have to do the analysis of the significant deviations. Maybe I expected the sales to grow by 10%. Then I set a threshold of 1 or 2%. So up to 12% is okay. But if the sales is 15%, that is when I will ask a question, how and how, what is the basis of increase in or jump in that. So that is my deriving of various matter or deriving of various analysis from the data itself. That is a very simple example. We'll get into more details of it. And last, obviously, document all the rationale, the results, and the conclusions of what has been done, how it has been done, and what are the conclusions, what are the significant deviations. And wherever, if you are not able to get any responses to the significant deviation, you may have to do an alternate procedure, or you may have to do an additional analytical procedure, or whatever that is actually required at that point in time. So we'll talk more about these things as we move ahead. First, let us look at risk assessment, which is a preliminary analytical review. So we start our audit with risk assessment. Risk assessment is guided by SA 315. So SA 315 also gives reference to SA 520, which talks about preliminary analytical review. So when we are talking about preliminary analytical review, what are the activities that we are doing? We are actually understanding the entity and its environment. So in that, what do? We pick up the last year financial statements. We understand the business operations, industry trends, regulatory environment. So industry trends and regulatory environment, all this is data analytics again. Industry also identifying the KPI that is relevant to the entity, so that we can understand more and more. For example, if I take a simple example of a cement industry, during COVID, there was this constructions were not very, robust, and then there were this unsold stock was also higher. So the demand for the cement industry was lower, for example. So it was lower by, say, the normal trend is 15%, but during that period, the same is only 5%. But if the company that you are auditing has 8 to 10%, that is what makes you ask. So then when we go and ask, maybe they are into infrastructure. At that time, the road work and other things got finished faster. So there is a higher demand for that company. So that is what is the anomaly that you get into. Then you investigate, conclude, and see whether it is appropriate or not. One thing to understand is that, very important point to understand is that, number one, we have to always take the base data. What is it that I want to compare with? For example, sales of the current year. Compare with what? Compare with two things. Two things are possible: internal data, external data. Internal data can be like budget, last year sales, projected sales, anything, right? So when we do that, we get a lesser assurance as compared to the external data. Second, this can be one analysis also, second can be another analysis. So I budgeted, I will increase sales by 20%. So compare with budget and then come with a conclusion. Okay, he has reached 19%, no significant deviation. Okay, fine. Now, when we say that 19% is okay, 21% is okay, that is the threshold that we have to decide. What is it that I am going to apply or I am going to okay it on? So, there can be, based on the threshold that I set, the threshold for the difference will also have to be set, in the sense my expectation is 15 to 20%. Okay, and what do I mean by 15 to 20%? That means I have 5% as the threshold. So the threshold, finalizing the threshold is also equally important. So when I say 5% threshold, it means that I can accept from 19 to 24%, right? So that is the next important step. When I get the data and I do the analysis, if it is beyond the threshold, if it is going beyond 23%, then I'm supposed to investigate, and then I'm supposed to note down all the reasons, and then also note down that what is the breakup of that, further analysis or additional testing that I have to do. Another important thing, the threshold cannot be only on the basis of percentage. It has to be on the basis of positive as well as negative percentage, or on the basis of a certain amount. So both types of threshold can be set. If the difference is more than this, or if the percentage is more than this, or if the delta is actually positive, negative, whatever. So that is very important. So when we do all these stuff, then we derive to a certain conclusion, and from that conclusion then we can actually draw the final conclusion based on how much assurance we have got. Another important thing that I would like to mention in this regard is that, in setting this threshold, in setting this expectation, in analyzing that what is okay or what is not okay, there is a lot of professional judgment that goes into. So it is very essential to document all that rationale. If I'm saying that, okay, cement industry demand is between 10 to 15%, how did I get the data? What is the source of that data? That is question number one. Second one, I'm setting a uh, threshold of say 3%. Where did I derive that 3% from? So these aspects, which are based on professional skepticism and professional judgment, has to be clearly documented. Most often what happens is that people look at it. Obviously, when we look at the data, we look at it and we look at the ratio also, and then we say, oh, 5% is fine. Okay, but we know it is fine. How do the reviewer or the third person know that it is fine? That is very essential to write down why it is fine, and the rationale has to come out very, very clearly. The next thing that we are doing at the time of risk assessment is preliminary analytical review. We gather financial as well as non-financial data. Excuse me. Financial as well as non-financial data. Non-financial data is mostly like what is happening in that geography, what is happening in that industry. Just to give you an example, if there is any regulatory ban on any product, right? There were certain chemicals that actually the government put ban on because of their misuse or something. So, say that is non-financial data. That may be not direct financial data. Then financial data, industry trends, the percentages and all that. So we have to combine both financial as well as non-financial data. And then, it will help us set our expectations. So that will include collect current and prior period financial statements, budget, forecast, management reports, also including non-financial data like production volumes, employee headcount, and market share. So we all do analytics, but the problem is that we do not get more assurance from it. So it is more about how to actually gather more sensible, responsible data and reliable data, and get assurance from the work that we do. Then ultimately, the third thing that you will do is perform ratio and trend analysis, current previous year's figures with the current year figures. Okay. And then you identify the risks basically. So at the preliminary stage, by doing this current year figure to last year figure, industry trend, business operation, KPI, comparing of the current and previous year ratios and all that stuff, you are actually identifying risk. So as per ISO 315, for example, if you have risk in say revenue, because revenue has got significant increase, expense has got significant increase or whatever, so it is still an optical measure of risk may be sitting in these kind of areas, and this can be not only quantitative, it can be qualitative risk measurement also, right? Then in the preliminary analytical review, we analyze ratios like gross profit margin, operating expenses ratio, return on assets, and also we look at the significant deviations or expectations and get get a comparison and also get a explanation at this time. So we say that out of the 15 financial statement areas, I have got 4 areas which seem to be quite a bit of movement over there. So does this have any risk? And before we actually conclude on if there is any risk over there, we actually look at those things to say that, okay, this is something that may be a risky area, or this is something that may be an area of concern. And we actually discuss and we finalize whether there is a risk or otherwise, right? Then we actually benchmark against industry or peers. We discuss this to say that we use the industry averages, competitor data to assess performance. We also identify outliers that may indicate misstatement of fraud risk. So we look at at the preliminary analytical review, we broadly look at P&L balance sheet level, or we don't get into schedule grouping level generally to assess the overall risk. If need be, you can go to the data to be used for the purposes of any analytical review depends on the requirement. You can actually go into any level, any granular level, or you can do at higher level. So when data is at higher level, generally the preliminary analytical review and the final analytical review is done at the larger level. And for all others, it is more done at a granular level, that is at individual area level. So, but it is still a choice that you can exercise, that you want to look at the balance sheet P&L level or the schedule level or into the grouping level. But the general practice is par and far, which we call preliminary analytical as well as final analytical, is generally at the balance sheet P&L level or max to max schedule level. It doesn't get into grouping level. Then correlate the financial and non-financial data as we spoke with. Compare monthly interest income with average yield on on advances example, and match employee costs with headcount trends and all this that we do, and then we do a preliminary analytical review over here, right? Then what do? We identify unusual or unexpected relationship. So when we look at some of the preliminary analytical review, obviously everything is connected to sales. The responses cannot be always so that the sales has increased, so purchase has increased, expenses increased because rent has increased, because sale has increased. So everything is not related to only sales or the revenue. There are other factors also in that area. The per square feet rent has increased. That may be a reason for increase in rent and not really the revenue. So we have to analyze and observe as to what is the trend and what is the relationship that is coming up with. We need to highlight areas with sudden spikes, declining margins, unusual expense patterns, and these can become our significant risk also. Then we document our observations and then plan our audit focus. We record the findings in the audit planning file, then use additional insights to determine areas which needs actually substantive testing or other testing. Then adjust our audit procedures based on risk assessment. Say, for example, in one area, which we already know that there is a higher risk. For example, if there is a company that has inventory obsolescence as a higher risk, and we already know that there is a risk, then we do a little bit more analysis into the data as to how much inventory was obsolete last year, current year, in the last 5 years trend, 10 years trend, and then we look at and then we re work on those things, and those kind of analytical data help us to make appropriate decision. What is the provision done on it? So ECL on trade debtors, all these trade receivables, all this can be more driven by a data analytics rather than a OSP, which is vouching and verification. verification, right? Then we come to execution of audit. Now we talked about high level analysis to identify the risk. So when I'm looking at the balance sheet P&L and looking at the procedures over there, it is higher level and it is upper level, and it has a lot of it helps me to plan the data. Plan the procedures. So one of the things when we update in the audit strategy, we look into what is the actually current situation of audit strategy, and then what are the plans that we are going to do. For example, TOC for 4 areas, OSP for 4 areas, then coupled with SAPs and things like that, right? So that is what helps us in doing that analytical review. Substantive analytical procedure. When we come to substantive analytical procedure, this is more complex and detailed in the sense when you are doing execution. So now I am, for example, doing audit of PPE. What are the analytical reviews that I can do? Depreciation reasonability analysis I can do. Addition, deletion as compared to last year, as compared to budget I can do. Capital commitment I can look into. So what is the assurance that I'm getting? So the point here is that we all do all these things, but we don't place assurance on it. How to get assurance from it is my data, base data, plus minus expectation, from based on my expectation to be developed based on proper analysis. There has to be a note for developing expectation. How did I get into this expectation? Discussed with the management is not the only basis. Going external, going to the industry trend, going into what is happening in the market. For example, now there is a decrease in GST on many products. So how is it affecting some acquisition? How is it affecting some sale, whatever? So do an analysis, look at industry reports. There are lots of industry reports that are available. There's a health sector industry report, there's an insurance industry report, there are government reports on all these things. So you can take it as a source of that data and then develop your expectation. After developing expectation, you decide a threshold. Anything above or below the threshold, then you will go and discuss with the client. So this is the detailed analysis for each of the areas that you are going to do where you are going to perform the SAP. By definition, this is evaluation of financial data through analysis of plausible relationship to obtain audit evidence. What is plausible relationship? Plausible relationship is basically the correlation, connection, or the update of various relationships. It's a plausible relationship means it may be due to this is what you are saying. So it gives you a reasonable assurance and at times moderate assurance. So you have to decide what is it that you are going to derive out of this, right? The purpose is to reduce the need of detailed testing by relying on patterns, trends, and ratios. So you must have often heard this sentence of, the data speaks more to me. Many of these, the data related analysts and data scientists, they actually talk about this. The data speaks to me more than the person does. So when you do inquiry observation with the client, so we know various types of audit techniques that we use: inquiry, observation, testing, analytical procedure, and all that. So when you are talking to someone, he is telling you certain things, but then when you look at the data actually speaks to you. What is the real trend? What are the observations or what are the anomalies, and how you can be looking into it more into detail to understand the data and to actually digest the data. So data actually more often speaks to you in a very clear manner as to what are the things, what are the anomalies underlying, what are the patterns, what are the trends, what are the ratios. These analyticals are also important for many other important steps of auditing. For example, to set materiality. So when we are setting materiality, one of the guidance that is given in SA 320 is more like look at the trends, look at whether the company is profit making, look at the data points, what are the objectives or the KPIs or the KRAs that is set by the investors, look at what is the objectives of the company and things like that. So all these are actually data points. And when we look at an audit file, it has to flow through from the planning to the completion at the same time. Well, many a times it so happens that someone does the planning, someone does the execution, someone else does the completion in the audit, because we have, staff turnover also in many of the firms. So what happens? Someone says that this company is profitable at the beginning, sets a materiality at so and so. While executing, he says, no, 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 this company was not profit making. Last year there was an extraordinary item which made it profitable. So he does audit on the basis of this, and in conclusion, again you say, okay, everything is fine. So that kind of connection also has to flow from planning to execution to closure. The purpose of SAP is more like it is reducing the need for all this kind of detailed testing by relying more on the patterns, trends, and the ratios. So the data can speak more and more to you. And when it is used during the audit fieldwork phase, especially when data is consistent and reliable. So these two things are very, very important. Your data has to be reliable, consistent. So relevance, reliability, and integrity. This doesn't go anywhere. This is very, very important. Relevance, reliability, as well as integrity. If you have this, then only you can use this. Otherwise, you are not able to use this, right? What are the conditions for use? Again, we kind of come to the repetitive, uh, you know, repetitive thing into the data reliability. So source data must be accurate and complete. So the data must be more reliable. Predictability, relationships must be stable and logical. So example, revenue versus receivables, purchases versus creditors. So there has to be relationships must be more stable and logical. If a company has too much of cash sales, right, then doing a revenue versus receivables is not going to give you uh, any kind of support. When you have too much of when you have a lot of uh, this trade receivable, then I think you are not going to get any respite from only doing sales analysis. You also have to do how much is the receivable, how is the ECL getting calculated. So ECL, when we are talking about, it is one of the best examples of how the data analytics or the data trend can be looked into. Because for the purpose of ECL itself, you generally look into what is the recoverability, what is the operating cycle, how the company has been receiving it, or what is the subsequent receipt of the data. So there are so much of information that is going into for calculation of ECL. And then there is so much of industry data also. So if it is a larger company, you have lot of industry data also that goes into it. For example, what is it in this industry? If it is if there are contracts with government, then 6 months is generally not considered as a appropriate period to say that it is not received. So you have to create some provision. Generally, it is beyond a 1 year. And then in certain tenders and contracts, you always have the retention money. So you have a longer period for that retention money. So all these are data and trends that you are digesting and then that you are applying, in other words, right? The predictability portion as to how this data will behave. All these things over a period of time when we are doing auditing, this is actually embedded in us. But then the only thing is that we are not writing it down in so many words. That is the only difference, because of which, only gap because of which we are not able to create more and more assurance, or get more and more assurance from the analytics. Precision, expectations must be quantifiedly defined. That is what we meant, the thresholds, whether in terms of money, whether in terms of amount, whether in terms of difference, whether in terms of percentage, range, everything has to be properly quantified, and there has to be a rational written down for that. Then the thresholds, auditor must set acceptable variance limits for investigation. If I'm saying 3%, 4%, then I have to justify as well as to why I'm taking 3% or 5% as a difference in the for the purposes of analysis of difference. Because if you take a very unreasonable threshold, for example, if I say 10%, if that I expect sales to be 20% increase, but I will take a range of 10%, then it may be not appropriate, because it may be not meeting the purpose at all. Because I want to look at more of why there is a change in the sales or why there is a change in the revenue. And then if I'm taking 10% as a threshold, then I think it will not meet the purpose. But at the same time, for expense, we may take a higher, little bit slightly higher percentage because of the inflation rate and other things. But then it depends on case to case basis. If, for example, you are in a service industry, then there is no direct COGS, or the cost of goods sold kind of. It is more of payroll and other such related cost. Then the percentages in respect of that will be have to be embedded, and then the industry percentage. So this kind of changes to data is quite off. Changes to threshold, expectation, rational is quite required. and this has to be consistently adjusted. And to know all this, it is necessary to have industry knowledge. So one of the things when we start audit, we always say that, do you have the industry expertise? Do you know how the industry is working? Do you know how the things have to be flowing in this function or in this company? So unless we have that, we will end up believing everything that the client is saying, which is against the professional skepticism again, and it will not actually fulfill the purpose of any kind of analysis, or even for that purpose, the very requirement of client acceptance as per the SQC itself. Yeah. What are the steps to perform the substantive analytical procedure? As we mentioned, develop the expectation. For developing the expectation, use historical data, budgets, industry benchmarks, define acceptable difference. We talked so much about the acceptable difference. Set the threshold based on the materiality, also on the basis of amount, on the basis of percentage range, as you deem appropriate. Compare the actual versus the expectation. It is not actual versus budget, it is actual versus expectation. Let me give you an example. I am doing a revenue analysis. Okay, I am doing a revenue analysis, especially for example, I am doing a product margin analysis within revenue analysis. In revenue, I can do 10 types of analysis. I am doing product margin analysis. So startup develop my expectation. Okay, this is a product, and how is it performing in the market? How are the other products, competitors product performing in the market? I set my expectation. So as per my expectation, it is 10%, for example. So the revenue is say 100. So my margin expectation is 10%. That is my expectation. And what is the threshold? I keep a 2% threshold, because in some of the companies of similar size and nature, there have been 12%, there have been 8% also. And this is a company which is actually more known in the market. So I say I would not go with 8%, but I would go 10 to 12%. So positive 2% is my threshold. Then I compare the actual. That is, say the actual is 115. I compare 115 with my expectation. What is my expectation? My expectation is base 100, that is last year's sales, plus 10, right? And my threshold is 2. So it will be 112 max to max, right? So I compare 110 with 115. Okay, in this example, this is crossing my threshold. So my expectation is 110 and my threshold is 2%. So the actual sales is 115. So which is more than my threshold also. So then I go and investigate the differences. This is how one has to think. When we say actual, the immediate thing that next come to us is budgeted. So it is not always actual versus budgeted. It is first go to the uh, actual or the base number, take the base number, set your expectation on that, and then compare that with the actual. So in the given case, if I'm saying for this product, it is 10 is my base, that is last year sales, expectation is 10, 110. So my expectation with the base is 110. I'm comparing with 115. Then that 115, 5 is my delta. Then I am actually comparing with my threshold, which is 2%. So I will ask for questions. This is what we are supposed to do, and all these steps needs to be defined appropriately so that we get the good assurance over it. Then investigate the deviation. So the whatever additional 3%, 2%, or the entire 5%, I'm going to discuss about, and I'll take the uh, details for the gap between 12 to 15 and 10 to 15, right? So that is what I have to do. Now what do? Do I stop there? Then I have to say, okay, this is fine, or this is in line with whatever is the explanation. Now I said that we have seen the market and everything, and then there is a 12 that we have derived, 110 that we have derived at, and 2 is my threshold. Now how did this additional 3 come? So they said that, oh, after the half year we launched another product with a new feature, the same product with a new feature, and that is why the sales after Diwali is higher. So am I satisfied with that? Go back and verify whether the sales has increased only after Diwali and for this product. If yes, then my analytical review is giving a satisfactory result. Most of the time, where does it go wrong? Generally, people do budget versus actual. That can give bare minimum assurance. It cannot give you anything more. Now, budget versus actual, when we do, we actually start with the actual, compare with the actual of the current year, compare it with the budget, and then come with a deviation. Then the rationale for the threshold is generally not documented. We do some analysis and then keep it open. We don't close it saying that this is satisfactory, unsatisfactory. Whereas if I have to get more assurance, I have to go beyond. I have budget, I have actual, I have to see the market trend, compare all the three, also ask for deviation between actual versus budget, but also ask for difference between if the market trend is so and so, why is it budgeted low or high, and what is the difference between the actual also. And then recheck the underlying data. When they give the difference, you check that whether it is actually so, and then you conclude. That is the complete analytical review. So generally, only a partial analytical review is done and it is documented, and many people believe that that is the best analytical review, but it is not. Developing of expectation is the heart of setting up the entire analytical review. Without development of expectation, if you're taking two figures and comparing, it can only give you trend analysis, it can only give you ratio analysis, it can give you differences. It doesn't give you analytical review actually. The analytical review procedure is one step or two steps beyond the normal compare of relationships. That is why more assurance cannot be drawn when only two figures that are already available are being compared to each other and actually looked at as a composite, answer. When you do so, that is why when the data is more independent to the organization, the reliance on the analytical review is higher, right? Ultimately, document findings, record the rationale, results, conclusions, everything. Few examples of substantive analytical procedure. Revenue analysis, we spoke about it. You can do a comparison of monthly, quarterly sales trends with prior years, vertical, horizontal slicing, dicing of data. Invest any unexpected spikes, drops, also compare it with the industry standards, develop the expectation, and conclude on the investigative part. When you are concluding on whatever explanation the client gives is not always right, please go back and also re-verify whether that explanation is appropriate, because you have the adequate data. Because generally this happens that we tell our teams to go and do the data analytics and ask for variance. So we will end up writing, sales 15% is an increase, this is based on market trend. Purchase is increased because sales has increased, trade receivable is increased because sales has increased, expense is increased because sales has increased, FD has increased because sales has increased. No, it doesn't correlate like that. It has to be actually seen as to why it is increasing or why it is decreasing. Interest income, say for example, bank audits, you can calculate the interest income using average loan balances, interest rates. So this is reasonability analysis. Actual income, if it is significantly higher, lower, then you can look at RBI circulars, you get the PLR, reverse PLR, all the rates, apply directly and then generate the interest and then compare it with the actual. It becomes more reasonable and it gives you higher assurance. Payroll, one of the areas where minimum OSP or minimum test of detail is required, because you can compare the total, you can do analysis of monthly payout, you can give you can actually do a deductions analysis, you can do a component wise analysis like HRA, TA and things like that. Then you can also do a headcount analysis like opening plus closing plus minus people who have left plus people who have joined, and then grade wise analysis. So there's so much that can be done by payroll within the entity as well as with the market trend, and then you can gain a large amount of comfort from the performance of these analytical procedures. COGS, quite complex. If you have a manufacturing company, you can do inventory analysis of various things. For example, the raw material, the consumption, yield, input output ratio, You can also do the analysis of WIP in terms of how much is the time taken, and what is the output, input to output once again, and the flow to the floor level analysis. Then you can do finished goods analysis on the basis of sales, on the basis of dispatch, on the basis of obsolescence. Then stores and spares is not possible to individually audit, but it can be a largely a reasonable review that you can do analytics itself. So I think especially in COGS, and then obviously the purchases analysis, the payable analysis in terms of this, and then the correlation between the sales and the COGS itself, and then the margin analysis, maybe product wise or maybe unit wise, or whatever that you want to do. So there is a lot that can be done in COGS area in terms of analytics itself, and you can derive a lot of comfort from the from this area in terms of analytics. Rent expense, as I mentioned, obviously not related directly to any of the other expenses, but rent expenses is generally done by analytics only, by comparing the per square feet rent, or by comparing what is the average rent in the area, what is the agreement say, what is the lock-in period, what is the increase, decrease, and then comparing with external data, with the stamp duty registration kind of uh, uh, ready reckoners that you will get in terms of rent also, and some of the urban areas also publish the rent average rates and everything, and then this can be derived from your analytics itself. Inventory turnover, we already spoke about. Inventory turnover, trade receivable, all this can be obviously the obsolescence, the ECLs, the provisions that can be measured can be largely analytical and reasonability review itself. For example, the forex was quite volatile for a company which actually deals more with export. There will be a lot of fluctuation in the receivable side of the balance sheet. So that analysis can be done through data analytics rather than verification of the invoice. Inventory also similarly, what is the ultimate sale output, input output ratio, what is the goods in stock and things like that. All that classification of inventory, all that we can do through analytical procedures. Now we come to the completion stage, which is mostly the final analytical procedures. So when we talk about the final analytical procedures, we take a step back. We identified the risks at the time of preliminary analytical review. Then we did detailed testing of each of the area. We developed our expectations, we matched, and then we have all these references, and then we know the reason. Now, as an auditor, when I look from starting to end, I am like in a comfortable position. I know how the balance sheet is moving, and I know how it is working towards. Then looking at all that stuff, then I actually come and start to conclude on the final analytical procedure. Once again, final analytical procedure is largely done at the balance sheet, P&L and schedule level. It is not done at the grouping level, because at the grouping level, at the account balance level, slicing dicing of data is mostly substantive analytical. When we come to the final analytical, it is more with a overall impact analysis, comparing the balance sheet, comparing the P&L, whether the trends that I have seen. So I have done so much of audit. Now I'm coming to the final balance sheet that I'm going to sign, and then I'm looking at the final review, and then go back and match with my SAP as well as the preliminary analytical, that whether the trend is similar. This also gives an individual analysis, or the anomalies will be identified, because I thought throughout the year I have been explained that purchases have increased by 15% only, and I have been given various reasons for that analytical review, and I have compared with the industry, it is going with 14 to 15%. But finally, when I see my P&L, I see that it is 22%. So then again, it is a question mark whether I have done all my work also appropriately, and whether all the information that I have received is appropriate. Say, for example, throughout the year, if it is 15%, but there is one entry that actually jumps in at the last minute and it becomes 21%, then it is worrisome, and I need to investigate it and ensure that it is appropriately passed into, in terms of how the audit evidence is there. So obviously the definition is more of analytical procedures performed near to the end or audit of the overall reasonableness of the financial statements. This is to ensure that the financial statements are aligning with the understanding of the auditor of the entity. So right from the beginning, I have been doing so many things. Is it aligning with what I'm thinking or is it not aligning with? This is the final stage where I will come and look at. So what do I do in final analytical? I validate the conclusions that I have drawn from the audit evidence right from the beginning to the end. If I do not get that appropriate conclusion, then that is when I have a problem, right? Identify any overlooked or contradictory trends. So that is when I, as we mentioned that if there are any overlooking trends, how can we match it and how can we look at it? Do we need to do further investigation into it? So we thought that, there have been, say, 10 crores additions to the PPE. So my final PPE number would be, say, at the opening it was 100 CR, then 10 CR, then it will be 110 minus the depreciation or something. But if the amount is something else, then I will identify it immediately and then I will be able to look at it appropriately. So the percentages once we do, when we, from the start to beginning, when we are doing the analytical reviews, we are in a flow, we understand what is it that is sitting. And then this will be the final stage where I am actually corroborating my understanding and also looking at any overlooked or contradictory trends that are there. Also ensuring consistency across the financial statements. That's something that is very important when before signing that we do, whether we have the consistency across the financial statements. Is there anything that is inconsistent as such? Then it also provides a final check before issuing the audit report. So that's actually very helpful, handy. The balance sheets that we audit, some of the financial statements which with a smaller number of line items or few transactions, I would say, it's more easier to have a bird's eye view or overlook or a final look of the financial statements, the P&L and balance sheet and the schedule level at the final analytical review. So it is my practice generally when the final review comes to me, there has to be a final analytical review. That is individual practice. It gives a kind of understanding of the overall audit procedures that we have done from start to end, and that can identify something that is glaring as well. So it gives you a quick bird's eye view on the entire thing. The procedures compare current year figures with prior years, budgets, trend analysis as usual, right? Analyze key ratios and compare over years. So important ratios, we also give disclosure of various ratios as per the Companies Act now. So the important ratios are already there. Additionally, if you have any typical ratios that are associated with the company, you can always put into practice saying that I need the 3 years trend. For example, the yield on the product or something like that is very different or very much varying. You can ask a question, or the current asset current liability ratio is one of the most important one. You can have a look at as to how it is performing over a period of time. So though we have it in a these things as a cursory indication in our mind, this final analytical actually makes you you can design your own. It's not necessary that current year versus previous year, current year versus budget, current year versus trend analysis. You can design your own final analytical procedure. What is it that you want to look at? Maybe for a manufacturing company, you want these 5 ratios plus this trend to be looked into. For a service level company, you want another 5 ratios plus another trend analysis that you want to look into. If you're into financial sector company, then you want to look at some of the important line items only, or some of the ratios that are very necessary only, things like this. Okay, you can design your own final analytical review, and then actually by looking at which you will get more of a comfort on the financial statements that you have done. But only looking at obviously is not a substitute to your audit procedures. You have done everything, and this is the final look that how it is being presented. So you can design your own, and that can help you in gaining that comfort. This also helps us to review relationship between financial and non-financial data. We spoke about non-financial data. Any other matters, any other things that are there underlying any non-financial data that is required to be taken into account. it actually helps us to look into this non-financial data as well. Then again, once again, we investigate any unexpected variances or anomalies, or if we know that this is the trend, then we summarize our finding itself and get it confirmed with the client. Sometimes it so happens you make your analytics, take it to the client, and then you ask the client to give references, and then he says you have made it, so you explain it. So it's not that way, but then you have to, he should be able to explain it because he is into the industry, he is doing all these things. So he should be able to explain those things to us. Now, how to get assurance from analytical procedures? We all do analytical procedure. As I mentioned, I think quite twice, thrice. We're not getting adequate assurance from analytical procedures because we are not doing it the right way, or we are not completing the analytical procedure. So use reliable and independent data. Avoid relying solely on management prepared schedules unless verified. So more the external data, more the reliability, right? Develop precise and predictive expectation. Your historical trends, budgets, forecasts, industry benchmark, non-financial data, whatever you get, the more precise your expectation, the stronger the assurance that you will get. So you should be able to predict your data, right? Self-appropriate, set as appropriate thresholds for the purpose of investigation. Always define what is significant difference based on materiality as well as risk. So if you are saying 3%, why 3%? Why not 4, 1 or 2? If you're saying 5%, write down the rationale why that 5%. So appropriate threshold setting is very, very important for any kind of assurance from SAP, to get any kind of assurance from SAP. Corroborate not only with financial data, but also with non-financial information. Link financial metrics with operational data. So there may be, goods movement that is linked with it. There can be, GST regulation that can be a trend for it. There can be some acquisition that is ongoing, that can be a trend for it. So link all the financial and non-financial data together to derive your overall conclusions. You can segment the data as much as you want. Break down data by whatever level you want: product line, geography, time period. This will help isolate your anomalies and also improve the accuracy of your expectation. So the more you dig into data, the more you will get comfort, because you are looking at from a holistic perspective here. You're not looking at from a sample perspective. You are playing with the whole of the data, and that data can speak to you instead of only a select amount of vouchers that you are looking into, which may not be able to give you the same input that the analytical procedures can give. Use disaggregated ratios and trends. Analyze as much as possible into ratios and trends. You can disaggregate, make it into further detailed, make it into unit wise and things like that. So those things one can do to whatever level they are required. Then ultimately investigate and resolve deviations. This is the final thing that we generally do not end up doing so well. So we have to perform the additional procedures if at all the explanations are vague or unsupported. So say for example, my revenue trend has to be 15%, but it is going to 22%. Then I ask them, then they say that, okay, there was one sale, oh sorry, this is a clubbing difference, this is a bifurcation difference, whatever. Then I go back to the data, get it corrected, relook at the percentage, or if any item is getting included which is appropriate as per accounting standard, then I look into that data and ensure that why that 7% increase is there. So that is my last and final stop. So step one, take the base data. Step two, develop the expectation based on information from the entity as well as from outside. Step three, set your threshold. Step 4, compare your actual with the expectation. And then step 5, investigate any differences beyond threshold. So, and then step 6 is, if there is explanation that is not supporting the reasonability, investigate, document and close. Then only your analytical procedure is complete. So mostly, you can do the substantive analytical procedure in this fashion to actually get and maximize assurance from analytical procedure. One thing I would like to state, this is obviously my personal view, is that once you get used to doing analytical procedure, you won't go back much to the detailed procedure or the OSP or the other substantive procedure or the test of detail that you're saying, because you get so much of more larger comfort from the entire data as compared to only a sample of say 25, 45, 110, 112, whatever you are calculating. You're looking at the entire data of 10,000 line items, 10 lakh line items or 1 crore line items as compared to 25 line items, 40 line items. So you will yourself start feeling that discomfort that, I have not looked at the entire data. So when you look at all these kind of, data analytics, the more and more deriving exceptions, data analytics more and more, you will start getting more and more comfort of the overall picture. So you get a holistic picture, which is much more easier as compared to segmented small piece of data. Key points that you have to remember for the purposes of documentation. It is necessary that what is the purpose of it, whether it is for the planning, testing, or final review. Please make a complete note of it. Whatever is the expectations developed, please ensure the basis of expectation, the historical data, budgets, industry benchmarks, methods that you have calculated to derive the expectation, all that have been properly documented. The thresholds for investigation, we have spoken, I think, quite a number of times. Define what contributes to a significant difference, linked to materiality and risk assessment. Always document the results and variances, details of any significant deviations, follow up actions, management explanations, additional procedures that need to be performed, and document all the conclusions that you are draw, whether results support corporate audit assertions, impact on audit opinion, or further testing. Whatever it is, you have to conclude on all these data. There are n number of tools. I'm not putting up any of the tool names over here, right? But why you can use more and more tools to actually do data analytics? It improves your accuracy, efficiency, consistency in the analysis of the data. It also automates complex comparisons and trend evaluations. So you can write some macros and you can run it, and then you can write some exceptions. You can write some SQL queries, and data can be fetched for the purposes of that. It strengthens the audit conclusions with data driven insights. There are lots of tools available online, offline these days. So you make use of any of these tools. What are the key benefits? It reduces your manual effort and also minimizes the human error. Enables more and more deeper insights from large data sets. It is made to actually fetch data directly from company systems. Also, at times you can attach the software and then it creates the dump, and then many auditors use tools for journal entry analysis. So they write the commands, and then the exception data, like whatever 999, the zero journal entries, the interledger journal entries, entries passed on holidays, all these categories generally that we use to test journal entries actually come up very easily. And also this supports in better documentation and the audit trail as to how we have been done it. Audit phase, how the tools help in terms of planning. At the past stage, it helps in analyzing the trends, ratios, industry benchmarks to identify risk areas. In SAP, it helps us to build expectation. There are some tools which are advanced, which actually, if you put up the industry, it can actually fetch data from the industry reports, and it can actually link it to the data and detect the anomalies. It also validates balances using statistical analysis here. Some of these data actually audit committees and some of the uh, those charged with governance get very impressed when you show data more in pictorial, in diagrammatic formats, and then if you can detect some of the things as auditors, more and more things that if you can detect for them, or if there are more things that are actually done than what is expected. All these audit committees, all the listed entities these days are expecting that the auditors use more and more tools to actually look at this data and look at and analyze and come back with some analysis and stuff like that. So there is a lot that is going on in this field. The less the more. So sorry, the more the less, and there is more and more that is happening every day. So there's a lot that is happening in this day, and then there is a lot of data analysis that is that people are also doing, exploring. Largely, that's all I have to discuss. Open for any questions.
Hello.
Yeah, hi.
Yeah, ma'am. Ma'am, you can close the PPT presentation.
Sure, I'll do. Yeah.
Yes. So thank you, ma'am, for sharing the valuable insights on SA 520. Uh, in today's session, we have joined by more than 700 participants, and we have received some questions from members. So
Sure.
I request you to please take these questions. So I will read the question and put the questions in chat box also for your reference,
Sure.
ma'am.
Yeah, that will be helpful. Thank you so much.
And the first question is, what type of data sources that can be used for developing auditor expectations in analytical procedures?
Yeah. So data sources can be your industry reports. It can be, some of the data that is available in the public domain. For example, there are many research agencies which actually come up with a lot of reports on trends in the industry. There will be business, research entities that also publishes a lot of report in terms of how the industry is behaving, what are the new things in this. For example, just to give you a perspective, there was one report on what all kinds of subsidies and what all kinds of benefits that the government is given and how many industries have taken it. For example, um, the chip manufacturing, or the sorry, not the chip manufacturing, the computer manufacturing entity, the assembling entity, how much it has taken. For cars, there will be another industry report. For automobile, there is another industry report. There will be an insurance industry report. So there are lots of reports that are available which actually give you the trends, and these research reports can be the base also. And then there can be other insights into understanding of the data, how what is the trend into the data. So there are websites which actually provide this kind of data on free basis also. All you have to do is sign up or subscribe to some of the insights that they are looking into, so you will get some of this data quite available if you're doing this kind of any of these kind of industries.
Okay. Then the next question is, what should the auditor do if the result of analytical procedures are inconsistent with the other audit evidences?
Yeah, sure. This is very important, and I think we spoke about this. So the company tells you that yes, I am doing a good sales, I am getting into 10% revenue increase year on year, something like that. And then you do some vouching verification, which is okay, because on the sample basis it is looking okay. But when you look at the larger data, that is when you understand that it is not in 10%, but it is actually in the range of 7 to 8%. That is when you have to investigate into the difference. What is the problem? And once it's test, once they give the explanation, then you have to go and verify that data also. For example, last year they had 5 customers, out of which one was a bigger customer. This year that customer is no more. They are trying to find a new customer. Till that time, the data is speaking the truth that the sales has fallen to 7 to 8% instead of 10%. Correct? So when you have that, then you will have to go and verify also what are the efforts that they are taking to find out new customers. When did the last customer contract end? What are the pros and cons of it? So that is how you will correlate the data. So there is financial as well as non-financial data that you have to link it to come to a conclusion.
Ma'am, when we use AI tools to extract data from large database, so what steps should we follow to ensure accuracy and reliability of the data, ma'am?
Yeah, so there are AI tools and there are AI also available to do all this data analytics for you. First and foremost caution is that when the product is free, you are the price. So you have to remember that you have to use a secure database, secure connection, and also a secure tool that you are using, which is authorized, because client confidentiality is very, very important. If you have that tool that you are using, and when you are looking at accuracy and reliability of data, yes, once you extract the data, so you're talking about extraction of data. So that is when we discussed about information produced by the entity and the test around it. So both, SA 315, 330 has this, and also the guidance note also talks about, and IFC also talks about this. When you're deriving some data from the client's system or client's report or AI tools, whatever, you have to always run a reliability and accuracy test. Like take a sample of it, verify whether it is matching the criteria. Simplest example I gave is that, you have a bucketing of the trade receivable 30 days, 30 to 60 days, 60 to 90 days. You are deriving the report, but pick up few samples to say whether they are these invoices are actually sitting in the 60 to 90 days, 90 to 180 days. And obviously the accuracy and overall matching you will have to do with the GL and the TB closure balance also. So those, without doing those steps, you should not embark on a analytical procedure journey.
Okay. Uh, Ma'am, how do we evaluate the reliability of data used in analytical procedure, especially when it is derived from internal management reports?
Yeah, so when it is based on internal management reports, I'm understanding it in two perspectives. One is internal management reports, which is derived from the system for which we talked about, IPE. Second is what the management is using to evaluate, for example, their own MIS. Then you have to see the source plus the reconciliation between the base data to the data that they are using. For example, they are using some regional data, maybe that system generated report is not there, but they're taking some other report and then making it in that format. So to look at the entire journey, look at the walkthrough of how is the data not losing its integrity and reliability in that journey, then only you can use it. If the relevance, reliability, or the integrity of data is getting compromised anywhere in that journey, then you cannot use that report for your purposes.
Ma'am, during the audit, we have observed that the company gross profit ratio has declined from 35% to 35% in previous declined from 35% in the previous year to 28% in the current year, despite an increase in the sales volume. So, what types of analytical procedures should that we perform that, and what could be the possible explanation for these changes?
Possible explanation, definitely I won't know what industry you're talking about. I don't have any insight into it and what are the responses. But then you're talking about gross profit ratio has declined. So it's not only the because of the sales that the gross profit will increase, right? There can be increase in your associated cost, in your increase in your various expenses. Yeah, there can be increase in various other factors, and also inflation can be one of the factors, if at all, that is affecting. If you are in a, if you're trading with the economy that has a higher inflation or something, some of the countries the currency itself is actually getting devalued. So if you are dealing with that kind of countries, then definitely your gross margin is going to fall. That is one of the example. Now explanation with respect to that I cannot give, but these are the examples that I gave. But then what are the analysis that you can take? You can do a product wise analysis, you can do a sales unit wise analysis, you can dig deeper into the entire MIS, how the company is maintaining and what is it that they are doing. If there is a significant decline in the gross margin itself, have they phased out any of? It is also possible that sometimes there's a product mix, 3 to 4 products. One product is selling less, but it has a higher gross profit margin. Another product is selling more, but then it has a lesser product margin. So which is the mix that you are using? Is the product mix that you are using is right, or things like that? So maybe you have to go beyond the finance function to find out and discuss these points to know that why is the gross profit coming down.
Yeah. Ma'am, what are the documentation requirement when we using AI assisted analytical procedures?
Yeah, documentation procedures would more or less stay the same. What are the tools that you are using? How reliable is the tool? Whether that is secure and safe, and whether it actually meets with your confidentiality requirements. Then you have all other documentation requirements, which actually we talked about on the slide, which I mentioned everything about how do you derive, what is the threshold, what are the analysis that you have done, how you have got satisfied, additional procedures you have done, and the conclusions. So those steps remain the same, but for the AI piece, you have to do the extra documentation on the source and the reliability.
Okay. So thank you, ma'am, for taking these questions and sharing the valuable insights on SA520. And I also thank you to all the participants for their active participation. So thank you, ma'am.
Thank you
Thank
so
you.
much, Vivek. Thank you, everyone. Thanks for the participation.
Thank you. Hello.